think the 25 is fine. I think that there are a lot of industrials. Stephanie and I were talking about it during the break, that the industrials could use it. I had Nick Akins on last week. He is the CEO of American Electric Power, which is the largest power transmission company in this country. And the deceleration is rather stark, both consumer and industrial, with the exception of some areas of Texas. And I think if the Fed were to look at that level of granularity, it would be so easy. Because Nick he's been a guest forever, and the expansion really tracked what he said, or you could argue he tracked the expansion. But electric use in this country is down, and it's not out of conservation. It's because of a real slowdown. I think it makes a lot of sense for Powell to do 25.
So the data is not necessarily showing us the real slowdown that we're seeing in power consumption. I mean, this is what China watchers used to point to.
Do you
right?
remember we used to get that data?
Right.
It was the only data that you would trust.
Yeah, but this isn't China. I mean, right? We have real economic data. I get what you're saying, Jim, and I can't discount that electric data, which is good data.
The largest power company in the country.
Boxcars, but
you can't rig it.
I got employers hiring 224,000 in the last month. I'm still looking for 166. I had retail sales, which were
beyond. It's not you that have it. It's our
beyond
country that has it.
The country has it as the economic. Right.
And I would point out that what Yellen said is, why can't we have an expansion? Why can't the numbers go the other way? I think that you and I, Steph, could name 20 companies right now whose deceleration is rather rapid.
Particularly in industrials and manufacturing. Auto, absolutely. And markets. I mean, look, at the end of the day, we've said this for a long time. Consumer is fine. It's the bulk of the economy, which is why the numbers still look pretty good, the top line numbers, GDP and all that. But manufacturing is really struggling. I mean, just look
at
tariffs, absolutely. But overall, global growth slowing. So while I think the Fed meeting this Wednesday is very important, the China PMI data is equally as important to me to see if we're going to see a stabilization. Because if that keeps on deteriorating, global growth is going to continue to deteriorate. And that's not a good thing. And then, of course, earnings are equally as important. But I think we have to get through these two events on Wednesday.
So I still believe that through 2020, the tensions with the Chinese are going to remain in place. I don't think that's going anywhere.
No.
That's staying with us. Okay. So with that said, manufacturing is going to have a headwind. It's going to remain in place. So what you want from the 25 basis point cut. Are you happy with 8% CapEx in 2019 increase for S&P companies?
I'll take it.
I would.
Okay.
I'll take it.
I sure
All right.
would.
So you want CapEx 8%, maybe 10% on a 25 basis point cut, 13% growth, buybacks 2019. You happy with that?
You bet.
Okay. So you want to focus on what are the companies going to do with what they're going to get from the Federal Reserve. And to me, it comes down to CapEx, maybe some M&A, and buybacks. If those can increase with the numbers that I just presented, then I think it's good for the market.
That's good stuff, huh?
I mean, to Jim's point, we've heard it on the conference calls already in terms of the number of mentions of China. Most of the mentions were done in a negative light. We were saying that is going to be another data set potentially that Jerome Powell could weigh going into this decision, or do you think it isn't?
I guess I am a little bit suspect, and I meant to be seen on this, that a Fed rate cut offsets the effects of a trade war. I'm not sure that that's the right answer, other than, I mean, there's two good reasons to cut. One is to meet the market expectations, because if you didn't, you'd have the kind of conditions that you'd have a market sell-off that would cause you a need to cut rates. And the other is maybe you change the CapEx calculation. A little hard, though, for a set of companies that just received an absolutely historic tax cut that brought the statutory rate down from 35% to 21%, to argue that a quarter-point rate cut is going to make the difference towards making an investment or not. And I have a hard time believing that. Now, if there's some sort of psychological effect on this, as well as meeting market expectations, and I would say little downside risk to it, because I don't see the incipient inflation out there, then I think, go ahead and do it. I'm just not sure that's the answer.